A few days ago, the Bank of Canada held interest rates, and a lot of people are taking that as good news, like things are finally starting to normalize. But here's the problem, that's not actually what the bank is saying. And if you misunderstood this moment, you could make a really bad decision in the real estate market in the next few months. So here's what the bank is actually doing. Right now, they're in what I would call a wait and see position. Inflation has come down to around their 2% target. The economy is slowing, but not collapsing, and there's still a lot of global uncertainty. So instead of raising or cutting rates, they're holding. But here's the part most people are missing. The bank themselves has said they're prepared to move rates in either direction depending on what happens in the next little bit. This isn't so much of a pivot as it is just a pause. So the big question is, what would actually force the bank to raise rates once again? There are really three main triggers, the first being inflation. Even though it's come down, it's still not perfectly stable. And if we start seeing it creep into things like goods and services, cost of energy, housing, we could see the bank raise rates again. The second trigger, a little bit counterintuitively, is actually a stronger than expected economy. If people keep spending money and employment remains strong, that's going to put pressure on prices, which 9 times out of 10 usually leads to higher rates. The third trigger is something a few months ago I would have actually said I think a lot of people are overlooking, but with the recent war in Iran, I think it's bringing a lot more people's attention onto it, and that's just global uncertainty or like global shocks. Trade issues, tariffs, we here in the Valley are seeing a huge spike in gas prices right now. All of these things have an effect. They can push prices for everything up really quickly, even if the economy is stalling or not growing. And that's a really dangerous combination because it creates inflation without any real growth. Okay, so here is the most important thing to understand. The Bank of Canada is not making decisions based on today. They're looking as far as 6 to 8 quarters into the future. So even if everything feels stable right now, if even a little hint of inflation comes back or enters the game again, the bank is going to act really quickly. That's just how central banks operate. Okay, now let's bring this into the real estate market. A lot of buyers are waiting on the sidelines right now, thinking to themselves, I'm going to hold off till things are a little more certain. Here's the reality. By the time things feel certain, a lot of opportunities are already gone. If rates stay stable, confidence returns and demand increases. If rates go up, supply tightens and pressure starts building. Either way, the window where buyers have leverage doesn't stay open forever. And we're already seeing very early signs of that window starting to close. So the golden question is, are rates going to go up or down? I really don't think it makes a lot of sense trying to answer that question. And in fact, I think a better question to ask is, if I'm going to wait, what if I'm wrong and all the opportunities in front of me evaporate? Now, obviously, there's a lot more to the story than a simple YouTube video can cover. So if you've been thinking about either buying, selling something in the Fraser Valley, or even just long-term planning, there's a link in the description below you can click on to book a call with me, and I'd be more than happy to walk you through your goals and how best to achieve them. Just remember, in a weird market like this, clarity is everything. As always, thanks for watching. I'm Matt, and I'm bringing you down to earth.